You know, Gremlin, I wish there was a way, just some way we can make a little bit extra money with our investments and do nothing about it. That would be nice, wouldn't it? How you guys doing? My name's Evan. Welcome back. This is Buy the Bulls, the only YouTube channel that encourages you to take your financial future and your trading gist. Buy the Bulls. Let's do it, boy. If you are new, we're going to be discussing all types of dividend stocks, the top 10 for 2022 that I see coming through. If you want to learn more about dividend investing and the stocks we're talking about today, watch the whole video. Got some great stuff in here for you. 10 great picks. We're going to discuss the fundamentals and the technicals of these companies, why they're good technically, why they're good fundamentally, where are we going to see value, and discuss what you can do in 2022 with these. If you truly enjoy this content, it's free for you to hit the like button, the subscribe button, and the bell notification. It's very helpful for me in a competitive field with gigantic people and 6-digit subs. I have 4, so I think a like and a subscribe would mean the world to me. I'd appreciate it. Please go check that out below. I do have some great stuff in the description box. I don't want to focus too much on that today. But again, in the description box, my whole channel, my free course, my YouTube channel, all the links are down there. The Patreon with the Discords in there as well. Go check that out as well. Some great stuff in there. I'd love if you go check that out. With that being said, we're going to cover 10 great dividend stocks today, what they do, how they're working, where's a good, a great, and amazing value for these, and what does 2022 look like for these dividend stocks. With that being said, let's get into it. So firstly, with the 10 stocks, you're going to see on the screen with technical analysis, when we go to the charts, you're going to see a red line. Anything near that price-wise is a good value. A yellow line is a great value, and the green line is an amazing value. The reason is, after this gigantic, Santa rally that we just had, there may be some stocks that are not the best value at the moment. Now, with the dividend, that's not really the issue. But we do want to buy low and sell high, or in this case, just buy low and hold for a long period of time. If you could buy low with these, you can have some great growth along with these. That makes this process much easier mentally, physically, emotionally. So make sure you look at that. We'll discuss that as well very easily. And secondly, we got to take earnings into consideration. A lot of companies, a lot of dividend stocks may have high yields, but their fundamentals are kind of trash. So I think that earnings does matter. The payout during earnings matters significantly for these, and that's been brought into consideration as well. With that being said, our first stock is AB. Alliance Bernstein Holdings LP. This is an investment management firm. What they're going to do is they're a company that provides investment information and management for U.S. public and private employees, such as foundations, retirement funds, pensions, endowments, banks, insurance companies, and high net worth individuals worldwide. What that means is they're basically going to take your money from your payouts and invest it for you. Now, I fully support you doing this by yourself, but AB is actually a fantastic pick when it comes to them doing it. Let's check it out together with their fundamentals. So this is AB's fundamentals. What's important to note through this video is what I'm going to focus on is PE ratio. This is going to be how much money you earn per share. This is great. The lower a PE ratio is, the better. If a PE ratio is over 15, over 20, it's a bit high. If it's over like 100, it's considered a growth company and not a value investment. Under 10 is the best. Under 10 is fantastic. And we see PE at 13, their A3 is fine. It's really good. Make sure the dividend yield's high at 7.3. That's fantastic. Good revenue, good earnings. All the stuff is positive here. Nothing looks terrible at all. When it comes to their valuation, it's fair. It's undervalued compared to the US average of 37. That's really good. Financially, you can read through this if you want to. It's really good financially. It's solid. The forecast is a bit dimmer than the finances, and that's fine. Performance, again, looks bad, but I'll show you the chart. It's actually done great. And then the dividend's fantastic. It's grown over 10 years. It's in the top 25%. AB is everything you want fundamentally for a company. When it comes to the charts, let's check it out together. So as I mentioned before, there's 3 lines on this chart for AB. Anything near below the red line is a good deal. Anything near below this yellow line is a great deal. Anything near below this green line is an amazing deal. If you watch my channel, we played AB a bunch of times off this trend line. It was absolutely amazing. Plenty of great hits. We made a bunch of money. It's starting to come down. That's fine because, again, you want to buy low and then hold for a long period of time. AB does have these systems of going up and coming back down and going back up. AB has plenty of growth potential behind it. I think for a earnings of 7.3% return, plus their earnings are pretty good, 81 cents, 91. You could probably see in a good year almost 14% to 15% returns with earnings. Overall, it's a fantastic looking stock. Again, lower lows, lower highs right now. But overall, AB just a bit lower is a fantastic deal. This year, AB has to be on your guys' watches for dividends. It's fantastic. It's a great company, great forward looking. Everything about it is fantastic. Next is Best Buy. If you don't know what Best Buy is, it's that gigantic company that sells you a bunch of electronics with a gigantic yellow tag. They put Radio Shack out of business. Best Buy is also fantastic this year. With Best Buy, we can see with the due diligence, massive market cap, under 10 PE ratio. That's the big one. It's fantastic. Their dividend yield's only 2.85%, not that high, but I'll show you why I chose this in a minute. It also has great revenue. It doesn't have that much debt compared to how much it's making. It makes a lot of sense here. When it comes to their valuation, it's a great deal. Again, it's almost 1/3 the cost as other companies when it comes to investing in it. Financials are fantastic. They're really good. Forecast is really good as well. Again, you may have some issues, seeing as COVID may be an issue. Performance has been really good, and then dividend, again, is fantastic. Now, the dividend's not nearly as high as something like AB, but I think it has plenty of potential, and I want to show you why. So when it comes to Best Buy, we're buying a company that does have growth behind it. It just had a massive earnings call, and it completely came down to a good value, about $100. Let's go back in time real quick. Best Buy is a rare company that also grows with time. A lot of companies like Coke, a lot of companies like Verizon, they're not going to see growth in the stock price. We're going to see a lot of growth just with the dividend. So this has that baked into it. You have a good 15-20% to run the next few years on top of your dividend, which is fantastic. I think, again, with earnings, $3, $2, $3, you're making almost 4%, 5% dividend yield plus earnings. And again, if you just go back to where it usually hangs around, it's about 20% increase right here. So I don't think Best Buy is the greatest dividend stock, but again, when you go to a gigantic company that has room to run and historically has done so with a good earnings and good dividend, again, Best Buy, a fantastic purchase this year. Next is CIM. This is Chimera Investment Corporation. This is a REIT, a real estate group that pays out money to its investors by the mortgages that they collect. This has a $3.8 billion capital consisting of great preferred stocks, investments, and capital. Since inception, they have made over $5.5 billion in stock dividend. What's even better with CIM is that their PE ratio is at 4.86 with a dividend yield of 8.15%. They have great earnings, great revenue, not that much debt at all, and again, it's had great evaluation. When it comes to their finances, it's really good. Financials are fantastic. Again, it's pretty good. Again, it's a bit high in debt, but that's okay, given the situation with COVID. Again, you're buying low, selling high. Performance, again, it's pretty good, and then dividends fantastic as well. I think that CIM can be a bit better statistically on the charts, but again, when it comes to just a dividend yield and buying low and selling high, it makes a lot of sense. Let's check it out together. I think the best value you're going to see is towards $14. Let's go back. Look at this. CIM used to hang around 14, 15, up to 20 bucks, and again, it had great returns. But as of COVID, it really kind of tanked. But again, we have great higher highs, great higher lows. Again, this is not a perfect trend line, but again, you have nice higher lows here. I think we could see CIM coming back down just a bit. Anywhere near 15 and anywhere near $14 is a fantastic entry. With earnings, 50, 30, 29, 30. Then you have about 42 cents, 54, 30 cents. I mean, you're paying $15 to make about 70 cents every 3 months. That's really good. We're talking about almost 5-6% returns a year, easily just with earnings on top of dividends. Fantastic. I think we may see $15 or $14 again soon. And again, to pay $14 to get about 70 cents 4 times a year is absolutely fantastic. CIM, to me, is a great dividend stock, a great REIT if you enjoy real estate. We're buying low, selling high, holding for a long period of time. CIM makes a whole lot of sense. So next is EOG Resources, Inc. This is a crude oil company that explores, develops, and produces the markets for crude oil. They also operate in all crude oil, NGLs, and natural gases, exploration and production related stuff with all natural resources. When it comes to EOG's fundamentals, a fantastically large group, great PE ratio, good 5.9 dividend yield, really good, great revenue, huge earnings. It does everything you want to see out of an energy company. It is important to note EVs are taking over in some respect. This may not be the best one for like a 30-year hold, but again, if they're one of the top at oil is not going anywhere nationally, let alone internationally. So again, it's a fine choice, but make sure you do your due diligence beyond this. When it comes to their valuation, it's really good. Great price. Financials, again, looks really good. Forecast, we have it's not the greatest due to EVs and stuff and folks staying home. Performance has been really good this year overall. And then again, their dividend has been growing, top 25%. It looks really good. So I think EOG up here doesn't make much sense to invest in quite yet. I think it should be just a bit lower. Let's go back real quick, the whole 10-year chart. We can see this one stays in the same $40 to $100 area. It goes back and forth, back and forth. We're at fair value here. We do have nice higher lows. I do think that EOG, if you can get below 85, is fantastic. Under 85, it's good. Under 75, it's best. Under 65 would be an absolutely insane investment for you. I think it'd be fantastic. We can see what comes with the dividend. 37 cents, 41, a dollar, 41, $2. But overall, with earnings, we're averaging about $2, $3 a month on an $88 stock. A bit lower, that's a fantastic ratio. I think EOG has room to drop to give us a better value because, again, buy low to get that growth. And then you can always sell if you wanted to, but again, we want to buy low to maximize shares. EOG here makes a whole lot of sense. I would definitely check it out for 2022. Next is a smaller company. It's called Coke. Coca-Cola? Oh, okay, yeah, you know what that is, right? You should know Coke is. That's a fantastic company. When it comes to Coke's fundamentals, it's absolutely a tank at $242 billion. International, everywhere, 2.89 dividend yield. Not the greatest, but I'm going to show you why we're going with it. Small PE ratio of 28. It could be a bit lower. Again, I think we may have a better price in the future. But again, we're going to see why it's a little bit higher than the other ones. But again, overall, an absolute monster, as we can see. When it comes to their valuation, it's really good. Again, it's a bit higher than the non-alcoholic industry, but it's okay. Financials look pretty good. Forecast, again, I think with COVID, nothing looks that great. Performance-wise, it's been pretty good. And then the dividend, again, is not the highest, but it's very consistent. Let's check the chart together and what we're looking at. So I think Coke at the moment at $58 is a bit high to invest in for a dividend return. The reason is, again, you get really good earnings mixed in. So we have about $1 here, about $1 here, 89 cents, $1 and some change. So you're getting about 4%, 5% with earnings at this price. But a bit lower, I think under 57, it's really good. At 55, it's great. At 53 bucks or so, it's amazing. If we zoom out, we can see Coke is one of the rare companies that over time does have higher lows and higher highs, and you could buy in and see maybe about 18, 19% growth. Wrong button, you idiot. Constantly, and you can see you can re-up at the bottom and get some great growth with your investment. So I think Coke at this point is a bit too high. I wouldn't go crazy at where it is, but I think it's a great one to look at. So again, I think Coke, $55, $54 after a pullback down here makes a whole lot of sense. Again, you're not going to have the great PE, or you're not going to have that great, return of like 5, 6, 7% like an AB would, but with growth, it looks fantastic. We're at the halfway point, and again, I would greatly appreciate it. A like, subscribe, all this kind of stuff really does help. It takes you 5 seconds. Again, I'll give you 5 seconds to do that real quick. I'd appreciate it. Thanks. Next is LYB. I actually just called this for the swing trade of it all, but it looks really good. LYB is Linden Basel Industries. It's a chemical company. They operate and make all the refinement technology for plastics, chemicals, manufactures a range of products, and people use their everyday lives, including food packaging, home furnishing, automotive components, paints, and coating. If you do those kinds of things, LYB is making it for you. It's a great company. Let's check out the fundamentals. When it comes to LYB's financials, a nice market cap of $32 billion. It's a good one. PE under 5.3. Boys, ladies, that's so good. Low PE, 5%, 4.9 dividend yield is really good. And again, good earnings, great revenue, more than their market cap, which is fantastic. Good gross margin. Everything here looks fantastic. When it comes to valuation, it's solid. It's beneath the usual PE. And in the chemical industry, it's averaging 44 PE ratio. It's at 5. That's fantastic. Financials look solid. Looks really good. Forecast, again, a bit weary because of what we're seeing with COVID. And again, it's down 3%. No big deal. Performance looks really good. And then the dividend, again, is top notch. It looks fantastic. Let's check the chart together. So you see these trend lines here. You may not be accustomed to what I do on charting. This is a downward wedge. These have a good chance and often break out and go up. So I think it's important to note this has a good chance of coming down a bit more and then continuing up. LYB historically has just stayed in this range beautifully, right? It stayed in this whole entire area. We could easily see some nice growth here to go higher, but LYB can easily see $70 or $60, so keep that in mind. When it comes to dividend, again, $1.13 plus $3 plus 6 plus 5. When this company makes money, boy, do you make money. This one can make a whole bunch of money here. LYB overall, I think you see $88 or 85 is much better than 95. But again, $95 to get a $6 raise the rest of your life every 3 months is pretty fantastic. LYB, when they make money, you make money. They're not going away. Great market cap, great dividend. I love what I see. I check it out. We got 3 more for you next. NXST. This is a media group that specializes and owns and uses television broadcasting and digital media companies. Focus on the acquisition, development, and operation of TV stations, interactive community, websites, and digital media. Given our stuff with COVID, they're not going anywhere. I think it's a fantastic one to look at. Let's check out the fundamentals. So again, $6 billion market cap, not the biggest company, but again, pretty fantastic. 7 PE ratio is fantastic. 1.83 dividend yield, not the greatest, but again, I'm gonna show you why I'm looking at it. It looks really good. Great revenue, huge revenue, looks good. You know, a bit higher debt than I like to see, but again, overall, a fantastic company. When it comes to their valuation, looks really good in comparison to other folks in their whole entire stratosphere, what they're doing, looks really good. Their financials look fantastic, looks really good. Again, the forecast given COVID, not too great many companies. Performance though, been fantastic, and their dividend, again, consistent, now in the top 25. While we're looking at it, let's check the chart together. NXST is a fantastic little range here. What this means is that this consolidation or sideways movement will most likely lead to a breakout or a break up. What I'm assuming here is that NXST eventually, their stock price is going to go up or go down majorly. So buying it now does make some sense to me. When we kind of zoom out together real quick to look at their 10-year, look at the growth of this company. It gets higher and higher. Just like with Coke, this is a rare company that has a good dividend, great earnings payout that also goes up. And with this consolidation, I mean, you're seeing $4 on earnings, you're seeing $7 on earnings, $4 on earnings. You're getting a great earnings calls plus growth. So you may not have the most fantastic looking dividend yield, but with earnings, it is really great. I think this has a great chance of going to 140. And if you lose that, you just wait, you buy in lower, but I think just a bit lower. You can see 5, 6, 7, 10% fairly easily every single year. NXST, I'd watch this dip, I'd check it out this year. It looks really great. Second to last is PM. This is Philip Morris International Holdings Company. They like to do cigarettes, and I mean, the sale of cigarettes and e-cigarettes are not going anywhere. Yes, sales have been down for years, which is actually a good thing, but again, I think cigarettes overall internationally, not going anywhere. Let's check out the fundamentals together. So Philip Morris, a $147 billion company. Again, smoking's not going anywhere. Good PE ratio of 16, could be lower, but again, with a 5.27% dividend yield, it's really good. Great revenue, making $80 billion a year. Great earnings calls, and again, their debt looks good. That's pretty good. Everything overall looks great financially. The valuation, it's low compared to a lot of other stuff in their markets. Again, 37 is really what we're looking at. Anything under that's really great. Again, 39 for a P ratio on average of this company type is really great at 16. Again, looks pretty good. Financials look, you know, okay. Forecast, again, with, you know, COVID, nothing looks great. Performance-wise this year, it's been pretty good, but then the dividend overall is an absolute tank. Let's check the chart together. So I think Philip Morris, as of recently, had a nice little channel down. It was going down, and now it broke out. Let's go ahead and zoom out real quick. Philip Morris, again, stays horizontal. This is not a stock that gets a lot of great growth on it, but anywhere below 85 bucks, it has a great chance of having some little bit of growth in there, right? We want to buy low to maximize our dividend yield. At 94 bucks, it's an okay value. I think we may come down more, you know, come down about 87, 90 bucks, 82 bucks. Anywhere down this area is a fantastic purchase. And again, about $270 for $94, about, you know, $270, $250. Overall, it's a great one to look at. I think a bit lower, Philip Morris makes a lot more sense, but I think going into COVID with stressors and stuff, I think cigarettes may have a good year. I think it's a good pick for sure. And then lastly is Verizon. If you don't know what Verizon is or what Coke is, how'd you find my videos? Right? I don't know. You know what they are. Let's check it out together. So currently, Verizon, a massive market cap. Again, they're about, you know, a little bit half of what Coke is. It looks like. Looks great. P ratio of under 10, fantastic. Good dividend yield of almost 5%, but 4.79 looks really good. You know, not, you know, debt's a bit high, but nothing crazy. Again, they make a bunch of money. They have great earnings. Overall, Verizon's a fantastic company. Again, really good valuation. Could be a bit lower, but it's pretty good. Financials, it's okay. Forecast, again, with COVID, nothing looks that great. Performance this year, I think with COVID coming, may even be better. And then dividend overall, an absolute tank. Let's check out the technicals together. So Verizon has a history of staying in a range. It doesn't really go anywhere. Verizon goes from 44 bucks to 60 almost religiously, right? It stays near 42 at the bottom, or 44, and goes up and then comes back down. And again, we're towards 52, so it's a fair evaluation. I think here, it's a fine purchase. I think lower at $44 is the best option, but again, it may take weeks, if not months, if not maybe a year to get that low. It does, you know, slowly burn down. But 52 bucks to get about $2, about $2, $2, $2, it's really good, right? If you were to buy, you know, 100 shares, that's going to be about $200, you know, raised to you every 3 months. That's really good. I think that you may be able to see it just a bit lower, right towards 51, maybe 50 bucks on here. And again, the market made a nice move up here, coming back down. But I think overall, Verizon has to be watched. Great company. And again, if COVID continues and if folks want to just keep using their cell phones, it's going to be great. I would definitely check it out. Thank you for watching. It means the world to me to watch the whole video. Again, like, subscribe, bell notification means a lot to me. Check out the description box for all my other content and my other kinds of services that I do. Otherwise, have a good 2022. I appreciate y'all more than you know. Me and my cat, Mr. Gremlin. Oh, come here, bud. Me and Gremlin want to thank you for a good year. We're going to see you. Meow. We're going to see you guys in 2022. Thanks a lot. We'll see you guys then. Appreciate it.